In order to get a thorough analysis of where a company stands, it is important that we take a look at different ratios and compare these ratios to previous years, other companies, and industry trends. We will start by looking at the profitability ratios. We have a steady increase in our gross margin percent throughout the years. As you can see, 52%, 52%, and 48% in 2015, 14, and 13. This ratio seems to be higher than most in our industry, which is a positive sign. We did, however, perform a vertical analysis where we found that we have more expenses to cover than our competitors. Knowing that we have more expenses, it's nice to see that we have a higher gross margin percent to cover these costs. Nautilus also has a return on assets of 10.82, 11.78, and 40.32% in the years 2015, 14, and 13 respectively. When looking at our competitor Cybex, we notice a very similar trend, but Nautilus seems to beat them each year. It's normal for this ratio to vary between years to correlate with the industry trends, but what this tells us is how efficient our management is using its assets to generate earnings. Any manager can create income by investing a lot of money into a problem, but looking at this ratio alone, it seems as though they are doing well. Return on equity is also an important ratio to look at. We had a ratio of 22.35, 18.55, and 71.10 in the years 2015, 14, and 13 respectively. If you look at this ratio among a 10-year span, you would notice that the ratio began in the negatives. Nautilus has done a great job of creating a positive return on equity. Our competitors have not done the same. This shows us that our management is finding a way to create income from equity that shareholders have contributed. Investors like to see this in a company. We've also looked at efficiency ratios such as receivables turnover. Our receivable turnover was 9.4, 10.64, and 9.29 in 2015, 14, and 13 respectively. Our competitors seem to have lower receivable turnovers. What this shows is that our company is efficiently issuing credit and collecting the funds. We do have credit policies in place which allow us to sell to credible customers, but they're not too specific to the point where our sales are being taken away by competitors with looser policies. This is a good thing. We also wanted to look at liquidity and financial leverage of our company. Nautilus has a current ratio of 1.73, 2.39, and 1.95 in 2015, 14, and 13 respectively. We have consistently been above 1, which shows that we are able to pay off our short-term liabilities with the current assets we have. Also, in 2015, Nautilus had a debt-to-equity ratio of 0.5. This means that for every dollar of assets, we have 50 cents in debt. This ratio shows that we do have the opportunity to take on more debt in order to expand our company. Our company seems to be solid when looking over the financial ratios. Our company wants to stay a top competitor, and we strive to find the newest innovations and technologies to keep our competitive advantage. One of the key findings from our ratio analysis is that we have the opportunity to take on debt in order to put money into research and development to find ways to keep us a top competitor. We are steadily increasing our profits year to year while also staying efficient and financially leveraged.